I want you to picture the global economy as this massive, intricate machine. Trillions of dollars of gears just grinding together every single second.
Mm-hmm.
Now imagine there's a ghost in that machine, an entity that is everywhere, involved in almost everything you do financially. But the average person will probably never see their logo on a building.
Right, or catch a commercial for them during the Super Bowl.
Exactly. It's the kind of invisibility that usually takes a lot of effort to maintain.
Oh, absolutely. We're talking about a firm that they don't have branches on Main Street, and they definitely do not care about managing your grandmother's pension fund.
No, they don't want your money. They have plenty of their own. We are talking about Jane Street.
Yeah.
And to simply call them a trading firm, I mean, it feels like calling the internet a library. It completely misses the scale. We are diving into a company with a portfolio valuation of over $662 billion.
It's just massive. To put that $662 billion in perspective, that is larger than the GDP of entire nations like Belgium or Sweden. Wow.
It's a staggering amount of capital for a firm that operates entirely behind the curtain.
And that's the mission for this deep dive. We've got a stack of sources here to go through. Regulatory reports from the SEC and the CFTC, academic journals breaking down market mechanics, and some very spicy legal filings from as recently as 2026.
Very recent, yeah.
We want to figure out, are these guys the invisible heroes keeping the market fluid and efficient? Or are they, as some recent lawsuits allege, essentially playing a video game with the global economy, where they somehow have the cheat codes?
It's a valid question. When you operate at that scale, the line between market efficiency and, well, market dominance, it gets very blurry.
To say the least. It's like playing Monopoly with real money.
Yeah. A necessary look into the mechanics of modern market structure, for sure.
So let's start with the basics, because when I think Wall Street, I still have that, that 1980s image of guys in suspenders yelling, buy, 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 on a packed trading floor.
Right.
I'm guessing Jane Street isn't that. Not even close. If you walked into their office, it would look more like a Silicon Valley startup, or really a university research lab, than a trading floor.
Okay.
They started in New York in 2000, which is relatively late in the grand scheme of Wall Street history. And they didn't start with traditional stocks. They focused on a niche that was just exploding at the time. ETFs, or exchange-traded funds.
We'll definitely get to the ETFs because that is their bread and butter.
Yeah.
But I want to pick on the who for a second.
Sure.
You mentioned a research lab. One of the articles we read described them as quantitative titans.
Right.
What does that actually mean in practice?
It means they don't hire finance bros.
Okay.
They hire physicists. They hire mathematicians who specialize in probability. The core of their strategy is proprietary trading, or prop trading.
Let's distinguish that for everyone.
Yeah.
If I go to BlackRock or Vanguard, they're fiduciaries. They take my $500 a month and invest it for me.
Mm-hmm.
Prop trading means Jane Street is only trading their own cash, right?
Mm. Exactly. They are the house. They are stepping into the casino with their own chips. And because it's their money, they aren't looking for long-term growth or value investing in the traditional sense.
Right.
They are looking for mathematical anomalies.
And this is where the physics comes in. I saw stochastic models mentioned in the Journal of Financial Economics source material about their strategy. Now, I barely passed algebra. How does physics help you trade stocks?
It's fascinating, actually. Think about Brownian motion.
Brownian motion?
Yeah, the way a dust particle moves randomly when it's suspended in a liquid or gas. It looks completely chaotic.
Sure, just bouncing around.
But physics has formulas to map that chaos, to predict the probability of where that particle might go next based on temperature, viscosity, and so on.
So they view a stock price not as a piece of a company, but as a particle moving in space.
Precisely. They treat the market as a fluid dynamic problem. They use machine learning and concepts from quantum physics to predict price movements that might only last for a nanosecond.
A nanosecond?
Yeah, they aren't trying to guess if Apple will release a good iPhone next year. They are trying to guess if Apple's stock price will move up by 1/10 of a penny in the next 50 milliseconds.
And if you do that enough times with enough money,
you get the numbers we're seeing today. In 2024, their net trading revenue hit $20.5 billion.
That is wild.
And in just one single quarter in 2025, QSU specifically, they brought in $10.1 billion.
Wow.
But look at the efficiency. Their profit margin is an eye-watering 69%.
That is the number that blew my mind. 69%.
Yeah.
I mean, traditional banks like JP Morgan or Citi, they're eating dust. They're usually happy with 20 or 30%, right?
Right. Traditional banks have massive overhead, Thousands of branches, ATMs, compliance officers for consumer loans, bad debt risks.
Yeah, tons of baggage.
Jane Street is lean, it's code, it's capital, and it's a relatively small team of just over 2,000 employees globally. They're essentially a software company that prints money.
Monopoly with real money.
Yeah.
But this brings up the hero argument we mentioned. Because Jane Street would say, hey, we're making all this money because we're providing a vital service. They claim they are making the market better for you, the everyday investor.
And according to a Stanford University study we looked at, there is truth to that. It comes down to spreads.
Break that down. If I'm buying a share of a company on my phone, why do I care about Jane Street's spread?
The spread is essentially the tax you pay to enter the market. It's the difference between the price you can buy a stock for and the price you can sell it for immediately.
Okay.
If there are no buyers or sellers, that gap widens. You might have to pay $100 to buy it, but could only sell it for $98. That $2 loss is the spread.
So Jane Street steps in and says, I'll buy it for $99.99 and sell it for $100.01.
Exactly. They act as market makers. And because they trade at such massive volume and speed, they can afford to make that gap tiny, fractions of a cent. They provide liquidity. They are always there to take the other side of the trade. That Stanford study highlights that high-frequency trading firms, or HFTs like Jane Street, have drastically reduced trading costs for retail investors over the last 2 decades.
So every time you buy a stock on your app and you don't pay a commission and the price is tight, you should technically send a thank you card to Jane Street.
In a way. But the study also notes the risk. They call it the liquidity paradox. Jane Street provides liquidity when times are good, but because they have no obligation to trade, remember, it's their own money, they can just turn the machines off.
And if they turn the machines off during a crash?
The liquidity evaporates instantly. This is what happened during the 2010 flash crash. When the market makers pull out, there is no one left to catch the falling knife. The market essentially hits an air pocket and drops.
Which is terrifying when you realize how much of the market they actually control. We talked about the plumbing of the market, specifically ETFs. Give us a sense of their dominance there.
It is massive. We are looking at sources indicating they handle about 24% of the entire U.S. primary ETF market.
Just them.
Just them. And 16% of the secondary market. But it gets even wilder in bond ETFs. They count for 41% of the volume there.
Nearly half of the bond ETF market runs through one firm.
Yes. And bonds are the bedrock of the global financial system. But let's look at something a bit more modern to see how this plumbing works in practice. The Bitcoin ETFs, specifically the BlackRock IBIT fund.
Right. The Bitcoin ETF was a huge story. Everyone focuses on BlackRock because their name's on the sticker. But Jane Street is the mechanic under the hood.
They are an authorized participant, or AP. This is crucial to understand. An ETF tracks the price of Bitcoin, right?
Yes.
But how? If Bitcoin goes up, why does the ETF stock go up? It doesn't happen by magic. It happens because an AP like Jane Street acts as a magician, stepping in to convert actual Bitcoin into ETF shares, and vice versa. They arbitrage the difference.
Arbitrage meaning they profit from the price difference.
Exactly. Let's say Bitcoin is trading at $100,000, but the ETF is trading at $99,000 because of selling pressure. Jane Street will buy the ETF shares and sell the actual Bitcoin, pocketing the difference and forcing the prices back in line. They're the connection point between the crypto world and the stock market.
But the SEC report studying this mentioned something about gray windows in this process. That sounds like a major risk factor.
It is, because Bitcoin trades 24/7, but the stock market closes at 4 p.m. And even during the day, the transfer of assets isn't instantaneous. There is a hedging process.
Right.
Jane Street has to hold the risk during that time gap. The gray window is that period where the money is in motion, and if the market moves violently during that window,
Someone is left holding the bag.
and usually firms like Jane Street are very, very good at ensuring it isn't them.
Which is a perfect segue, because if they were just efficient market plumbers, we wouldn't be seeing all these recent headlines. But moving into the shadows and scandals between 2022 and 2026, the vibe really changed.
It did. The narrative shifted from market efficiency to accusations of market manipulation. And we have to start with the Terraform Labs case.
Terraform. This was the collapse of the Terra USD stablecoin back in 2022. It wiped out $40 billion in value. I remember everyday people losing their life savings.
It was a massive tragedy for retail investors, but years later, in a 2026 legal filing, the bankruptcy estate sued Jane Street. They alleged that Jane Street engaged in insider trading.
Specifically, the accusation is that they used non-public information to withdraw $85 million in liquidity right before the crash, right?
Minutes before. The lawsuit paints a picture of Jane Street spotting the fracture in the dam, getting their own money to high ground, and essentially betting on the flood. The lawsuit characterizes the move as desperate.
Now, to be fair, Jane Street denies this completely. They argue it was just risk management. But the plaintiffs argue they had access to order flow data that gave them an unfair heads up.
That is the core defense versus the core accusation. Jane Street says they saw a bad setup and exited.
But that wasn't the only controversy. We have to look at the India ban, the regulatory action taken by SEBI, the Securities and Exchange Board of India, in 2025.
This one is fascinating because it wasn't just a slap on the wrist. They were banned from certain trading activities. The scheme involved manipulating the Bank Nifty index.
Walk us through the mechanics of this, because the scale of it sounds like a heist movie.
It really does. So here is the setup. You have the Bank Nifty index, which tracks banking stocks in India, and then you have options on that index, bets on whether it will go up or down.
Standard stuff so far.
Right. But here's the trick. Whistleblower reports and studies by FTI Consulting found that Jane Street would buy a massive amount of the actual cash stocks in the index. High volume, aggressive buying.
Which artificially inflates the price of the index.
Correct. But they weren't trying to make money on the stocks. They might even lose a little or break even on that trade. The goal was to spike the index so that their massive options positions would skyrocket in value.
So they use the stocks as a lever to pry open the jackpot on the options market.
Exactly. Options have leverage. A small move in the underlying index creates a massive percentage gain in the option. So they spend, say, $10 million to move the market, but they make $50 million on the options.
SEBI estimated the illegal gains at around $553 million, right?
Yeah.
With a total potential market impact of $4 billion.
Yes. $4 billion of value moved around just so one firm could hit a profit target.
And that's the fear. That the tail is wagging the dog, the derivatives are controlling the actual market. It plays right into the crypto X rumors we see.
Ah, the 10 a.m. dumps.
Yes, the 2026 speculation on social media. I see these threads all the time where people swear the market is rigged, that Jane Street dumps Bitcoin via ETFs at specific times to suppress the price.
Now, most analysts generally reject this as a myth. Bitcoin is just too big and decentralized to be manipulated that easily by one player. But the fact that people believe it shows the intense level of public distrust.
Well, it didn't help that Jane Street deleted their tweets on X following the lawsuits. That gave off major conspiracy movie vibes.
Yeah, that was a suspicious move. When the legal filings started piling up, they scrubbed their social media. For a company that relies on being the invisible architects of the market, trying to erase your digital footprints just makes everyone stare at you harder.
So we have a firm that posted a staggering $17.3 billion in profit for the first half of 2025 alone. They thrive on global volatility. Are they the hero driving efficiency or the villain extracting rent from the global economy?
It's a paradox, and it's not binary.
Break down both sides for us.
The hero argument is strong. Without Jane Street, your ETF portfolio would likely have higher fees and wider spreads. The markets would be slower. Reports from the BIS, the Bank for International Settlements, support this. They use cutting-edge tech to modernize finance.
But the villain argument is what we see in the SEBI ban and the Terraform lawsuit.
Exactly. Those cases suggest that when algorithms run the show and a firm becomes this dominant, ethics can get bypassed for profit. The algorithm doesn't have a moral compass. It has a profit maximization function.
And this leads us to the future, because regulatory scrutiny is tightening. We've seen U.S. fines regarding crypto hedging. But you mentioned earlier that we are moving beyond just physics and math into AI.
Yes. The rise of AI in trading could amplify these manipulation risks exponentially. We've been talking about quants writing complex formulas. The next phase is machine learning models that write their own rules in real time.
And so the black box gets even blacker.
And much faster. If the SEBI investigation in India took months or years to unravel algorithmic manipulation, imagine trying to unravel a trade pattern executed by an AI that evolves every hour.
Regulators are already overwhelmed. I've heard the term GDPR for finance thrown around in the academic journals. What would that look like?
It's the idea that we need new financial laws. Strict guardrails, not just on what you trade, but on the data and algorithms you use to trade. Right now, we need transparency laws that force these firms to prove their algorithms aren't predatory by design.
To recap, we have this dual nature of Jane Street. They are an essential liquidity provider, absolutely vital to the system, but they operate with a black box that frankly scares regulators.
It does. As they grow deeper into bond trading and crypto, systemic risk grows with them.
So for you listening, why should you care? If you own ETFs, whether it's the S&P 500 or a Bitcoin fund, Jane Street is likely the engine under the hood. Diversification is key, but understanding who the authorized participants are helps you understand the structural risks of what you own.
Exactly. Don't try to outtrade the high-frequency algorithms. Play the long game.
Good advice.
Yeah,
We covered a lot of ground today, but I want to leave you with one final provocative thought.
let's hear it.
We talked about how regulation is trying to catch up, but in a world where these proprietary algorithms are making decisions in milliseconds using quantum physics concepts that 99% of the population can't even grasp, is it even possible for human regulators to ever actually catch up? Or is the game now permanently rigged in favor of the machines?
That is the trillion-dollar question.
Something to mull over the next time you hit buy on your brokerage app. Thanks for diving deep with us today.
Thanks for having me.
We'll catch you on the next Deep Dive.